In this video, I want to talk about stocks that I would not buy for long-term investing, and I will explain why. I have a couple of sectors, a couple of industries, a couple of patterns that I follow on the markets, and sometimes I like the way it's going. I can spot the opportunity, and sometimes I have the reverse. I've been following the markets for more than 10 years now, and sometimes you have some basic red flags. And I don't see a lot of people on YouTube talking about the red flags of investing. Even on Twitter, we only highlight the good opportunities, the stock that will double, triple, but you mostly want to avoid the mistakes. You want to make as little mistakes, as few mistakes as possible. So in this video, it will just be a chat between you and I will talk to you about the stocks you basically want to avoid, which is great. I mean, you want to minimize your mistakes. In case you don't know me, this is a channel for stock pickers. My name is Christophe Nour. I've been investing in the market for almost a decade now, and I have achieved a performance of 25% per year. So I have a concentrated portfolio of stocks that I love. Great investments, great opportunities. But a lot of people pitch some opportunities to me. Almost every day they pitch an investment idea, and most of the time I dismiss it. By the way, you are more than welcome to pitch an idea in the comment section below. But most of the time, it's not my style. It's not my style for several reasons. First, I would never invest in a company that is unprofitable and has been profitable for a long track record. Only because most of the time, these unprofitable businesses are unprofitable for a reason. There is not enough customers, or the business model is too aggressive with the pricing, or there is no demand, or they have too much competition, so they have to... you have countless examples of companies that were unprofitable. People expect a reversion to the mean, and the reversion to the mean never happens. You've had this kind of bubble in 2018 with the cannabis stocks, with the stocks. You've had countless examples during the 2021 EV bubble. You have Nikola, you have Ford, the EV department of Ford that was going to be a banger and that failed completely. Same thing for Stellantis and EVs. You have a lot of companies with unprofitable segments and they never recover. And most of the time, for the companies that have unprofitable segments, they want to double down. They want to invest a lot of capex. So they burn cash. And after 3 years, they burned even more cash. And there was never a reversion to the mean. And as an investor, if you believed in management at the time with their investor presentation, you believed in the recovery, in the profitability in the future, you would have missed great gains. You would have lost a lot of money. You would have lost patience. You would have lost sleep. It will be very stressful, and that's an opportunity cost. Most of the time, companies that are unprofitable stay unprofitable, and that's an opportunity cost because you could have been invested in a profitable business that is growing nicely. For these unprofitable businesses, you will have some examples, counter examples. You will tell me you have Spotify that increased their prices and now are becoming a free cash flow machine. You have Uber that is now becoming highly profitable, again a free cash flow machine. You have Amazon. You have a lot of examples of companies that were not profitable for years, and now they snap and they become profitable. That's an exception. If you average things out, if you take the average unprofitable company, they suffer a lot, and their investors suffer a lot. So the stress, in my opinion, is not worth it. What I favor for an investing style is to only focus on companies with very high margins that make a lot of money and have been profitable for years and years and years, even in 2008. You have such companies, and they never have to worry about profitability. They don't have debt. They are flushed with cash. This is a great problem to have. You have too much cash. You don't know what to do with the cash. Either you pay dividend, buyback, M&A, acquisition. Anything. That's a very good problem to have. That's the way Warren Buffett and Charlie Munger looked at companies for decades. You want to invest in cash-heavy businesses, it's a better problem to have. So first, I would totally avoid unprofitable businesses. The second the second kind of company I would completely avoid is the companies with, I would say, no track record, with a business model with no proof of results. A new business model, a new tech, a new startup, a new IPO that came out of nowhere and have no precedent, and you can't really compare the IPO with another company. You have such companies, and in 2020, 2021, you had plenty of IPOs with a new business model that came out of life, out of thin air, and it turned out that after 2 years, 3 years, the business model doesn't work. You have examples like this. You have people on Twitter, on YouTube, pitching these stocks. But most of the time, you lose money if you do this. The past, contrary to what is said, the past is a very good indicator for the future. If a company has done well for 20 years, it's very likely that they will not die for the next few years, for the next 3 years. So focus on the track record. That's very important. If you check my portfolio, by the way, my portfolio is public on eToro. You can just type my name and you will have my portfolio, because I'm talking about my portfolio, but you can check it live. If you look at my portfolio, you will see a lot of companies, all the companies that have been generating free cash flow all years long. I mean, for decades. So very profitable businesses, free cash flow generative. And what is good about the track record is you can check what the management has done with the cash. If you have a track record of 20 years, you have a sense of the vision of management. If they want to do M&A or dividends or buybacks or have a lot of debt, how do you manage your debt? The maturities. Do you borrow in yen, in dollars? Do you borrow short-term debt, long-term debt? You can have a sense of what the management is thinking. Do they like dividends? Do they like buybacks? Is this a family that runs the business? What is the insider ownership? That is a great question, and that's part of my analysis. For small companies that are recently public, you don't have the track record. You don't know what the vision for management is. You don't know if they have done a good job over the past 10 years because the company didn't exist. You don't know if they will do well in the future because you have no track record. You can't concentrate. You can't really guesstimate how the future will be for these businesses. And I want to avoid this stress. This is stressful to be uncertain about the future. I mean, the world is already uncertain. We have inflation, interest rates, some wars in the world, some change in politics in the US or even here in France. You have a lot of changes happening. The world is already blur and uncertain. So it's better to reduce uncertainty in your life and focus on companies with a lot of track record. I would never invest in a company with no track record. The only IPO I invested in was Landbridge because, I mean, it's an IPO from 2024, but it's very similar to a company I owned, TPL, like very, very similar. So I knew that this business model was going to work, highly profitable, etc., etc., etc. And apart from this IPO, I never bought an IPO. And the only IPO I bought was with a proven business model that will work for decades. So rather safe, you would say. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The other thing that I would completely avoid for long-term investing is investing in fads. Fads are temporary. That's a very sexy industry, sexy area. I mean, cannabis stocks in 2018, EVs 2021, that's some good examples. You have some international trades, whether it's Latin America or African names. You have some countries sometimes that pop and you have great returns, and that's the new bull market. You have a new bull market somewhere in the world, and after 2 years, the bull market collapses. So if you are a short-term trader, yes, you can take advantage of it. But for long-term investing, I would definitely not recommend this one. So fads, stuff that is unproven, unprofitable businesses, these are good indicators of mistakes you want to avoid. Stay clear of all these areas. And I've been studying great investors for more than 10 years now. I've read maybe not all of them, but a lot of the letters from the best investors, All the investors you have on this list, the super investors, Data Roma, I've seen a lot of their letters. And they don't do this. They don't invest in fads. They don't invest in the new thing that will become hype for 1 year or two. So I would completely avoid the hype, regardless of the price. GameStop, AMC, meme stocks, Nokia, Blockbuster, all this stuff that the retail investors are interested in, you can completely avoid this one. What I would favor for long-term investing are profitable, proven business models in a temporary problem, temporary drop in price. That I love this setup. I've made a lot of money with this setup, and I'm glad the market is irrational, because I will find other opportunities like this, and I will make a lot of money out of these situations. Life is good. So avoid fads, avoid unprofitable businesses, avoid unproven business model. That's a very good starting point. And the last thing for long-term investing, the last thing I would avoid are businesses that are too expensive. That is very easy to say, but very difficult to do in real life. Because sometimes you will find a good investment opportunity, you like the business model, you like the charismatic CEO, but the stock is trading at too high a price, like a PE ratio of 80 or 90. You have such examples right now. You had FICO, Fair Isaac with a PE ratio of 100. You had TPL in the past with a PE ratio of 80. You have other tech companies. You have some businesses, great companies. Everybody knows they are great companies, so everybody is willing to pay a little bit more. You have a premium, and at a PE ratio of 80, the premium is too high. So I'd rather stay clear of these stocks because of too high a price. In the long term, the entry price is important. The entry price matters. If you think in terms of 5 years, let's say 5-year investment horizon, right? That's even long term for YouTube. So that will impact largely your stock performance. If you buy a stock and your entry point is an PE ratio of 80, and then you have a reversion to the mean to a PE ratio of 20 or 30, you have a huge opportunity cost. You can watch more videos on the internet about this topic. You have a huge opportunity cost to invest in high growth company, highly leveraged companies at a high price. That's a stupid mistake and a simple mistake to arrange. I mean, for me personally, my investing style is very simple. I plan to invest in great companies, and I want a PE ratio below 30. That's simple. That's it. You have a threshold. I don't plan to go above 30. So if the PE ratio is 60, I just dismiss the investment idea. And most of the time, the stocks that people talk about that are quite expensive, quite famous, quite expensive. So that's okay. By the way, a small tip for you, since I'm talking about valuation, the valuations are not the same depending on the country. The PE ratio for the S&P 500 on average is right now 30. So you will have businesses that are at a valuation around 30. But for China, the average PE ratio is 10, 15. So you will have a lower valuation. Don't think that a PE ratio of 15 is cheap in China. So don't compare the PE ratios. Just say that the PE ratio of 10 is cheap because it's in China. Countries are important. Different countries have different valuations because of regulation, growth opportunities, president. That happens. So be careful about valuation, by the way. If you find a good stock, for example, in Colombia, sitting at a PE of 6, don't think that it's a crazy deal. Just do your own due diligence. Compare it with the average PE ratio of the country, so you can have a good sense on the relative PE ratio. You can see if this is cheap or expensive. So that's another actionable tip for you for your future estimates of valuation. Yeah, basically that would be it. avoid what is unpredictable. The world is already unpredictable. I want to invest for the long term in safe companies, good management, profitable business model, proven business model at a good valuation. And that's the reason why I outperform the market. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.